Ooh, so Silicon Valley, the 16th largest US bank, has collapsed and the fear of contagion is spreading, with the potential of seeing cascading financial effects that will start to surface as more people uncover how many other businesses have funds or related exposure to SVB. Many are fearing the worst because there's concerns that we could see another financial crisis like we did in 2008. Today, we're gonna cover how SVB failed, how this is affecting crypto, and how the markets are reacting to the recent news that the government made this morning in a joint statement. So how massive is this collapse? SVB is the second biggest bank failure in US history since the 2008 financial crisis. Here's an overview and a gist of what happened. SVB is the 16th largest American bank and was named by Forbes as America's best banks with a A Moody rating. This was aptly named Silicon Valley Bank because it was home to half of all venture-backed startups. And this is how they made a majority of their money, where 89% was made on corporate deposits. And the way they attracted these high-value clients was offering higher interest rate returns on deposits compared to their other competitors. Imagine you're a newly funded startup bootstrapping and trying to make the most of your funds. And usually a bank account is considered a safer way to make a return, right? You'll see interest rates ranging from anywhere from 1% to 3.5%. But then you see that juicy 4.5% at Silicon Valley Bank. Might as well go with them compared to the 3.75 from these other competitors. 88% of Forbes 2022 next billion-dollar startups are SVB clients. And then about 50% of all US-backed tech and life science companies bank at SVB. If you're a newer company, a newer startup, you're gonna think, this sounds legit, so they can't all be wrong, right? This is where it takes a turn for the worse. The question is, how is Silicon Valley Bank able to fund these high returns? What they did was they bought bonds before the Fed began to fiercely start increasing rate hikes. And generally, bond values decrease as the Fed increases interest rates. To protect against the risk, financial institutions usually have a hedge, and this is used to protect against a potential downside and to limit losses. A hedge is an opposite investment where the price generally moves in the opposite direction of what you want to protect. SVB invested in long duration bonds over a 10-year period, but did not have a hedge in place to protect against the longer duration risk of holding those bonds. This would normally be noticed by regulators for larger institutions like JP Morgan, but in SVB's case, they were small enough to be unnoticed. According to the director of global macro at Fidelity, they say, this is a classic asset to liability mismatch, triggered by higher interest rates compounded by leverage. There's an old adage that says, the Fed tightens until something breaks. A bank run happened after SVB showed that it lost $1.8 billion in asset sales. They failed to receive new capital funding and then got a downgraded Moody credit score, leading investors and depositors trying to pull out $42 billion on Thursday, March 9th, equaling to a $1 billion negative cash balance. On Friday, the collapse was inevitable and the government intervened, and massive people were looking to see how this bank collapse affected the entire financial system. And today we're going to talk about how crypto reacted initially and the aftermath of today's news. The biggest fears in the market was USDC, which is the second largest stablecoin that had lost its dollar peg over the weekend and fell as low as 82 cents to the dollar at one point. All the concerns and panic is due to Circle, the company that issues USDC, having $3.3 billion in cash deposits at Silicon Valley Bank, which represents about 8% of the total reserve backing. And USDC is a crypto stablecoin that represents the dollar and is redeemable from $1 USDC to $1 normally. And it's been touted as having 100% reserves behind the USDC, meaning that for every one USDC, it is backed by Circle owning $1. USDC has been the stablecoin of choice for most users because of this and their transparency. However, things changed once Silicon Valley Bank shut down on Friday, March 10th, panicking the whole market, wondering where the contagion effects could spread. And this is major news because USDC is the second largest stablecoin and is a keystone of the crypto system. So when fear of USDC being affected, USDC lost its peg. And a peg is just the market value of a crypto to an external asset. So in this case, it's USDC losing its market value to the dollar, no longer being $1 USDC to $1. It fell as hard as 82 cents. So this sparked a lot of fear of an impending crisis similar to what we saw in the 2008 subprime financial crisis. There's uncertainty of how far this risk could spread, and if any of that money that is locked up inside SVB is needed to pay back others in crypto, it can create rippling effects like we saw within the Terra Luna collapse or the FTX debacles. In response, we are seeing crypto users start to de-risk by transferring out of centralized exchanges. Most traders that I know have diversified their stablecoins from USDC into a mix of Tether and DAI, plus a random smattering of other things. But still, there's a little bit of hesitation around Tether, which is understandably, I'll make a video on that in the future. So others are taking a portion of their USDC holdings and swapping into ETH and Bitcoin. So naturally, with the concerns of what to do to minimize the risk to USDC, we saw an uptick in the price of Bitcoin and Ethereum because of all of this buying. And personally, within MVHQ, the top NFT trading group that I'm in, I saw this play out the same way, where top traders swapped into a variety of different stablecoins, swapped into ETH, or a few said this was the first time they bought Bitcoin in a long time. It was provided as an alternative to central banking to help protect against bank runs like we're seeing with the collapse of SVB. Circle has then come out with statements to ease the fear within the market, stating that as a regulated payment token, USDC will remain redeemable one for one with the US dollars. Reuters notes about Circle, the cryptocurrency firm said that even the bank does not return 100% of their deposits. It will cover any shortfall using corporate resources involving external capital if necessary. But this still doesn't mean crypto is independent of everything. Crypto is still a part of the macro financial landscape. But there looks to be good news based on the joint statement by the Treasury, the Fed, and FDIC released on Sunday night. In the release, it states, Secretary Yellen approved actions enabling FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a matter that fully protects all depositors. Depositors will have access to all their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer, which is actually really interesting because those were major concerns. And to protect against the other contagion risks spreading and rippling through the banking industry, the statement adds, the Federal Reserve Board on Sunday announced it'll make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all the depositors. The release of this was appropriately timed right before Asian markets opened to stem the potential risk of this getting significantly worse. So on the heels of this news, we've seen Bitcoin rally over 18% and is now over 24,000, with Ethereum close to 1,700. If there's anything I've learned from being inside this space, I'd rather be overly cautious and potentially lose a small amount of money than to not take action and lose a lot of money. So what I'm going to be doing is I'm waiting for this to pan out before making any significant moves within crypto, besides my typical dollar cost averaging within crypto, and then my short-term NFT trading and my long-term holds. As of recording this, I do not own any USDC and have moved a majority of my crypto off exchanges. This is not investment advice, just educational content, so consult your financial advisors and do your own research to make the best decision for yourself. But here's something to think about. Because something broke, is this the beginning of a potential Fed pivot of lowering interest rates sooner than most people think? This is on our radar now, so let's watch and see to see how this plays out. I'll be doing more research and I'm going to create a future video once I understand more on the potential pivot and how it's going to be playing out. So subscribe to the channel to see that in the future. And as always, take care, talk soon, and I'll see you in the next video.